Tax season has just wrapped up, and a lot of people are now thinking about how much tax they owe and pay this year. In today's video, we'll focus on how parents can legally reduce their taxes by taking advantage of valuable tax benefits related to their children. A few days ago, we just finished filing our own taxes. I don't know about you, but for me, it's no longer a good feeling. Tax season used to be my favorite time of the year. I would file early, get a refund, and feel like I did something right. But now, with my wife working, I dread every filing season. Every year, I owe huge amounts to the federal and state governments, which makes me sweat during every year's tax filing weekend. This year again, I owed over $20,000, and honestly, every time I hit that submit button, I feel stressed because I had to figure out where that money is going to come from. Living in a high tax state, almost half of what we earn, whether through work or investments, just disappears to federal and state taxes, Social Security, Medicare, and investment taxes. Over the past few years, I started to notice something that really made me pause. For many families, nearly half of what we earn ultimately goes to taxes before we even get a chance to spend or save it for our family's future. And that raises a natural question. Is it really worth working harder and earning more if so much of the extra income is taxed away? But what bothers me even more was this. It seems like some people were legally paying much less tax than others, even at similar income levels. That curiosity pushed me down a path of digging into tax rules and strategies, especially those that apply to families like ours. And over time, I discovered there are completely legal ways parents can significantly reduce their tax burden, sometimes by thousands of dollars a year. And that led me to a simple realization. Instead of only focusing on earning more, it can be just as powerful to understand how to legally keep more of what you already earn. In addition to my own frustration with a large tax bill, a recent experience shared by a friend further motivated me to create this video and talk about tax saving strategies that parents can use to keep more of their hard-earned money in their own pockets. Here's what happened to my friend. Last year, he had to sell stocks to help pay for his child's tuition, which unfortunately triggered a significant capital gains tax bill on top of already overwhelming college expenses. What made it worse was that he was unaware of several legal strategies that could have helped, such as using 529 plans, strategic timing of asset sales and gifts, or taking advantage of a child's lower tax bracket. It really highlighted a simple reality. A large portion of our wealth ends up supporting our children, one way or another. So it's worth being intentional about how we structure it from a tax perspective. In this video, I will walk you through some of these key strategies. To start, I want to emphasize something most families are never told. Families are taxed differently from individuals, but most parents are never taught how to use that difference to their advantage. As a result, many families end up paying far more in taxes than they legally need to. In reality, smart family tax strategies can make a very big difference over time. When you have children, you don't just have dependents, you have planning opportunities. And when these strategies are used correctly, they can legally reduce taxes by thousands of dollars over the years. Smart planning can help you save significant tax dollars, protect financial aid eligibility, and make your money work harder for a child's education and their life. First, let's talk about lower tax rates for kids. Many parents don't realize that stocks can be transferred to their children. The key idea here is that capital gains are taxed based on who sells the stock, not who bought it or originally own it. If the child has little or no income, their tax rate can be very low, sometimes can be even zero. Now here's an important comparison. We're not talking about a large gain, we're talking about the same $2,700 gain. If a parent sells the stock, that gain is taxed at the parent's tax rate up to 37%. If a child sells the stock, that same gain may be taxed at 0 to 10%, and this is not a one-time opportunity. This applies every year, meaning parents can transfer stocks with up to $2,700 per year when done correctly. Finally, remember, what matters here is the capital gain, not the total value of the stock being transferred. Now, if we want to take advantage of a child's lower tax bracket, we also have to talk about the kiddie tax. The kiddie tax exists to prevent parents from shifting income purely to avoid taxes. Here are the 2026 rules. The first $1,350 of a child's investment income is tax-free. The next $1,350 is taxed at the child's rate, which is 10%. But anything above $2,700 is taxed at the parent's rate. This is where many parents make the biggest mistake. They shift too much money too quickly. Large transfers done at the wrong time often lose their tax benefit, even though the strategy itself is perfectly legal when used correctly. Let's walk through a concrete example so you can see how the kiddie tax works in real life. In this example, we have a college student who received a $90,000 stock gift. Of that $90,000, $60,000 is capital gain. The child is 20 years old and has no other income. At first glance, parents might assume this entire gain will be taxed at the child's low rate. But once we apply the kiddie tax rules, the result looks very different. The first $1,350 of investment capital gain is tax-free, so that results in zero tax. The next $1,350 is taxed at the child's rate of 10%, which comes out to $135. Everything above $2,700 is subject to the kiddie tax and gets taxed at the parent's rate. In this case, $57,300 is taxed at 37%, resulting in over $21,000 for tax. When we add everything together, the total tax bill comes out to $21,336. The key takeaway here is that with a large gift during college, most of the gain ends up being taxed at the parent's high rate, so this strategy saves very little tax. This is exactly why timing and gift size matter so much when using family tax strategies. Now, let's look at a second example, where the numbers and the outcome are very different. In this case, the college student received a much smaller stock gift. The stock is worth $5,000 and the capital gain is $3,000. We apply the same kiddie tax rules as before. The first $1,350 of investment income is tax-free, so that results in zero tax. The next $1,350 is taxed at the child's rate of 10%, which comes out to $135. That leaves only $300 above the $2,700 threshold. That portion is subject to the kiddie tax and is taxed at the parent's rate, resulting in tax about $111. When we add everything together, the total tax comes out to just about $246. The key takeaway here is that small gains stay mostly below the kiddie tax threshold. This is why transferring smaller gains during and before college can still preserve the tax benefit. Let's step back and summarize the key takeaways from these college stock gift examples. When the stock gift is large, most of the capital gain ends up being taxed at the parent's rate, even though part of the gain is tax-free or taxed at the child's rate. The majority quickly spills over into the kiddie tax and loses the intended benefit. On the other hand, when the stock gift is small, most or all of the gain stays within the child's lower tax brackets. In that case, the gain is taxed at 0% or 10%, and the strategy works much more effectively. So the big lesson here is simple. With college stock gifts, timing and size matter. Large gifts at the wrong time are mostly taxed at the parent's rate. Smaller, well-timed gains are more likely to be taxed at the child's rate. That's why smart family tax planning is not about doing more. It's about doing it at the right time and in the right amounts. This naturally leads to the next question. If the size and the timing matter so much, how do families actually plan this in real life? This slide shows how families think about tax planning over multiple years, not just in a single year. When children are young, families often start with things like 529 contributions, which allow money to grow tax-free for education. As children get older, families can begin gifting stocks gradually instead of all at once. Each year, they harvest gains carefully and keep those gains below the kiddie tax limits whenever possible. You can see that year by year, small amounts of gains may be taxed at 0% or 10% instead of splitting into parents' higher tax bracket. Over time, this approach allows families to accumulate meaningful savings without triggering unnecessary taxes. By the time college expenses need to be paid, much of the money has already been positioned in a tax-efficient way. The big idea here is that families don't rush this process. They take small, deliberate steps each year, and those small steps, when done consistently over time, can add up to big savings for college. At this point, the pattern should be pretty clear. It's not just what strategy you use, it's when you use it. That's why timing really matters. In the younger years, most families focus on building a foundation. This is where 529 plans work best. Money grows tax-free, stays flexible, and doesn't create kiddie tax issues. As children reach their college years, the strategy shifts. This is when small stock gifts can make sense, but only in controlled amounts. The goal is to keep capital gains low and stay under the kiddie tax limits. That's why small gifts during college tend to work, while large ones often do not. After graduation, the rules change again. Once the child is independent and no longer subject to kiddie tax, larger gifts can finally make sense. So when we recap the college year strategy, the rules are simple. Avoid large capital gains in child's name. Withdraw from 529 first, and keep annual gains under $2,700 whenever possible. When families follow this sequence, they minimize taxes and maximize financial aid. That's the power of getting the timing right. Next, let's talk about what changes after graduation when different strategies start to make sense. After graduation, selling gifted stocks can be completely tax-free. This is often the best time to harvest large capital gains. Right after graduation, children typically become independent, but many of them also earn a relatively low salary when they are just starting their careers. Let's look at an example. Suppose there is a $40,000 stock gain and the child is now independent. In this case, the entire gain fits within the child's 0% long-term capital gains bracket, resulting in zero tax. In 2026, a single filer can have up to $65,550 of gross income and still pay no federal tax. Once we combine the 0% capital gains bracket with a standard deduction, that means in the graduation year, parents can gift up to $65,550 minus whatever income the child earns that year and have the stock sold completely tax-free. This is why post-graduation is often the most powerful window for harvesting large gains. Now let's bring everything together with one multi-stage example. This shows how families can combine different strategies over time to reduce taxes across many years, not just one. We'll start when the child is young. In this stage, the family contributes $10,000 to 529 plan. Over time, that grows to $21,000, all tax-free when used for education. The tax owed here is zero. Next, during the college years, the family gives a small amount of stock. In this example, the stock has a $3,000 gain. Because the gain stays mostly within the kiddie tax limits, the total tax owed is just $246. The key here is that the gift is small and carefully timed. Finally, after graduation, the strategy changes again. The child is now independent and earns a relatively low income. At this point, the family gives the stock with a $40,000 gain. The entire gain fits within the child's 0% long-term capital gains bracket, resulting in zero tax. When you look at all three stages together, the pattern becomes clear. 529 plans work best when kids are young. Small stock gifts can work during college. And large gains are best harvested after graduation. By combining these strategies across different stages, families can save thousands of dollars in taxes over time. Before we wrap up, I want to zoom out and briefly introduce what is often called the ultimate long-term wealth strategy. It's summarized in 3 words: buy, borrow, die. The first step is to buy assets. This can include stocks, real estate, or businesses. Basically, assets that are expected to grow in value over time. The key idea is that as long as you don't sell, you don't trigger capital gains taxes. The second step is to borrow against those assets. Instead of selling and realizing taxable gains, owners can borrow using the assets as collateral. Borrowed money is not considered taxable income, so no tax is triggered at this stage. The final step happens at death. When assets are passed on, the cost basis is reset under current tax law. That means the built-in capital gains can disappear, and heirs receive assets with a new starting value for tax purposes. Stepping back, the big picture is this. Long-term planning isn't just about minimizing taxes in a single year. It's about understanding how taxes work across an entire lifetime and even across generations. This is why timing, patience, and planning play such a powerful role in building and preserving health. The key tax rule that makes this buy, borrow, die strategy possible is called the step-up in basis. Let's walk through a simple example. On the left side, imagine an asset that was originally purchased for $10,000. Over time, the asset grows in value to $100,000. At this point, there is a $90,000 unrealized gain. If this asset were sold during the owner's lifetime, that gain would normally be subject to capital gains tax. But when the owner passes away, something important happens. Under the current tax law, the cost basis of the asset is reset. Instead of carrying over the original $10,000 basis, the asset receives a new basis equal to its market value at death. In this example, the new basis becomes $100,000. That means the $90,000 of unrealized gain effectively disappears for tax purposes. As a result, the heirs can sell the asset with little to no capital gains tax owed. This step up in basis is what allows long-term investors to defer taxes during life and potentially eliminate them at death. And that's why understanding this rule is so critical when thinking about long-term and generational tax planning. So after seeing how step up in basis works, the natural question becomes, what does all of this actually mean for you and your family? When you step back, the trade-offs are pretty clear. If you sell assets early, you lock in gains right away, and that usually means paying higher taxes. On the other hand, if you hold assets and plan the timing carefully, you can significantly reduce the amount of tax you owe. And when you layer smart timing with the family strategies, like using lower tax brackets and planning transfers across different life stages, that's where maximum savings come from. The key takeaway here is that taxes are not just about income, they're about timing. Strategic planning allows you to reset when taxes are triggered, instead of letting taxes control when you act. That's why thoughtful planning isn't about doing something complicated. It's about making informed choices that keep more of your money working for you and your family over time. If you found this video helpful, please take a second to give a thumbs up. It really helps more parents discover these strategies and keep more of their hard-earned money. Feel free to share this video with other families who might benefit, especially parents thinking ahead about education and taxes. And if you don't want to miss future videos like this, make sure to subscribe and turn on notifications. I'll be sharing more practical, real-world strategies to help families save smarter and live better. And I'll see you in the next video.